Hello, my name is Nicole Elliott and I'm a technical analyst and private investor. And I thought today, with all the hoo-ha about Brexit yet again, I'd look at sort of sterling things, British things, and see how they're doing. And so my first chart is the value of the pound against the US dollar. And yesterday we went up as high as 1.335 US dollars and cents needed to buy yourself £1. And in fact, the whole tone this year has been very different. On the very first trading day in January, on my chart, you'll see there's a massive hammer on it. And from then we've moved up in three distinct phases. We're in the third phase at the moment. So I'm suggesting that this is part of a bigger five-wave rally that should get the pound back up to, I mean, something like, I'd say maybe about 136, 137 US dollars per pound. Definitely on the chart, the clouds are supportive, the moving averages are bullish once again. And more importantly, there have been too many people too short for way too long on this one. You know, since the referendum, we got down as low as 1.2 US dollars. Now at 1.33 and a bit, we're sort of halfway between the low and the post-referendum high, which was 143. So we're roughly in the middle of things, which is quite a good place to be. My second chart is the euro. Sterling against the euro sterling as we quote it in banks. And this week, for the first time, we've dipped below 86 pence. In other words, you need fewer and fewer pennies to buy yourself a euro. We're currently at the strongest against the euro since July 2017. It's not a watershed level we're at all. There's nothing like that. It's just that there have been tiny incremental gains in the value of the pound against the euro. Interestingly too, over the last 2 months, i.e. January and February this year, the cost of insuring yourself and being able to sell pounds against the euro has dropped quite significantly. The implied volatility that the option market makers are using has really come down a lot, suggesting they, like people in cable, have been forced to cut these stale positions they've been nursing for way too long. My final chart is the FTSE 100 index. It's a weekly chart. Again, it's got my Ichimoku clouds that I like to use a lot. And what we have seen since the very beginning of 2017 is a massive broadening top formation. We're still inside it. We're in fact pretty much at the middle of it. We're literally this week we've just traded down from the halfway point between the record high that we saw in early 2018 and the low at Christmas last year. So we're halfway there. It's a bounce. Very much it's a corrective bounce that we've seen. It's 8 weeks in the making, which I'm suggesting is rather long in the tooth by now, and it's about time to stop and go down again. The reason I say it should go down again is that all moving averages on this one are bearish, i.e. they suggest that you should be selling the FTSE 100. Now what's interesting with this too is that yesterday the Norges Bank that runs and helps maintain the Norway Sovereign Wealth Fund, which is worth $1 trillion, they came out yesterday saying that A, they had been buying US equities on the dip at Christmas, and then they were also going to buy UK property, corporate and government bonds, and shares. They're planning to buy for the long term. Brexit, no Brexit, deal or no deal. I thought that was very interesting, actually, and they have, as I say, very deep pockets. But in my opinion, they shouldn't be buying now because they'll certainly are likely to get it cheaper soon.